everybody. This is Colin G. Murphy, and welcome to Colin Podcasting About Real Estate Show 52. Now, given this is Show 52, I guess in some ways this is our 1 year anniversary of the podcast, which is awesome. Done a podcast every single week for 52 weeks. So, big thank you to you, my listeners, for making it happen. I've really enjoyed this journey with you so far. I hope you have too. Let's hope there's many more years of Colin podcasting about real estate ahead of us. And I hope there is, because I'm really enjoying them. There seems to be a never-ending list of people that are interested in coming onto the show and sharing their interesting stories and giving us their insider tips on how to improve our real estate journeys, and whether that's lenders and note holders, property managers and wholesalers and investors and coaches and loads of different people that have lots of interesting experience, from people that have owned hundreds of properties or managed thousands of properties or sold thousands of properties or coached hundreds of people. I've had all sorts of people on the show, and I've really enjoyed picking their brains and getting the information out of them that might help me improve my real estate journey, but just as importantly, improve you as well, and help you improve your real estate journey too. So I'd actually be really interested if anybody would like to send an email to info@colininvestments.com and let me know what show you enjoyed the most and why. I'd consider that a really big favor if you send an email to info@colininvestments.com. Let me know what show you enjoyed the most and why. And if you want, also let me know what types of guests you'd like me to bring on the show in year 2 of Colin podcasting about real estate. I think that could be a fun exercise, and I would love to read those emails, and I promise I will respond to each one individually myself as well. If you take the time to write it, I will take the time to respond to you. Okay, but moving on, getting on to today's show. I got a good one. Have you ever wondered why people with high credit scores sometimes get declined for loans while others always get approved for lots of them, dozens of them in some cases? Do you want some actionable tips on how to easily avoid the major mistakes that can derail mortgage loan applications? Are you interested in a finance expert's views on what is going to happen to the real estate market when the mortgage moratoriums actually expire? Because they were 6 months and then 12 months, and now some people are getting 18 months. That's not going to go on much longer than June 2021. Are you interested in finding out what happens next? If so, check out this chat that I had with a gentleman called Merrill Chandler of Get Fundable. And it's been almost a year. I think it was show 2. I had Graham Parham, who's a lending expert, on the show, and it's been almost a year since I've had one. And I was delighted to spend some time with an industry veteran, because a lot of things have changed in the lending market in the last year. So it was high time we got someone back. And you look, according to Merrill, we're in the eye of a hurricane right now. Things are very calm. The weather is sunny. The job markets are looking good. Interest rates are down. Real estate prices going up. It's probably safe to assume that will not always be the case, that conditions will not always seem so benign. And if so, there is no harm in taking some steps to position yourself, number 1, for protection, but number 2, and just as importantly, if not more so, to be in a position to take advantage of the opportunities that are going to crop up when things get a little choppy out there. And this is an important show for many reasons, and you get a lot of insights, particularly in the second half of the show. I think the majority of the insights come in the second half of the show, but there's some good stuff in the first half as well, don't get me wrong. But check it out. Let's head on over. You let me know, and let's head on over and see what Merrill has to say. Merrill Chandler, how are you doing? Welcome to the show.
I'm excited to be here, Colin. It's a pleasure always, and I've heard great things about you and your tribe from some of our mutual contacts, right? And so I'm just thrilled to be here.
Awesome. Well, I can't wait to dig into the nitty gritty with an actual lender, someone who's an expert about how people can get real estate loans, because it obviously is crucial. Anybody wants to build wealth or real estate, it's very hard to do it without getting a bunch of mortgages, and the industry has changed dramatically in the last 2 years, in the last 10 years. So I'd love to learn about your journey through that, and what it's like nowadays to get a loan, and what pitfalls people need to avoid. So looking forward to this conversation, but let's start at the beginning. Tell us a bit about yourself, Merrill. Where'd you grow up?
Well, first of all, I'm a native of California, And I was there for the first 30 years of my life. The second 30 years of my life, I've been here in Utah, which I call home now. But interestingly enough, the transition from California to here actually kind of speaks to what we're talking about. I'd sold an interest in a Silicon Valley business, and I'd sold my home. I'd kind of had my first live and flip experience, pulled 100 grand out of a deal. And then me and my wife and my newborn child are sitting there going, now what do you want to do? We sold the business, we sold the house, and we some friends invited us, said, hey, Utah is kind of starting the very appreciation rise that we'd experienced in California at the time. So we go out there. So my roots are in real estate investing as well. The problem is that I took all those proceeds and I put it into a single trade that I thought, because I was young and dumb, and I thought this trade was just going to be the cat's meow, right? I'd 5x or 10x my money, dropped a few $100,000 into this trade, and it came out at 5, was supposed to go to 12. I got out at 67 cents. And so I had, and so I lost my shirt. It was the first time and the only time in the markets where I was foolish enough, young enough, dumb enough to make such absurd investment plays, right? Well, when I moved out to Utah, one of my friends was doing credit repair in the Utah space. And I didn't know what credit was at the time, right? I didn't know. I thought when you went to an auto dealer, you literally, somebody looked at the computer, says, you're approved. I didn't know about credit bureaus. I didn't know anything. And so he told me about credit repair. And I was like, this is strange. And as a result of all my research, we actually built and grew Lexington Law Firm, the largest credit repair law firm in the country.
Okay.
Problem is that I watching our customers. If you delete a few negative items from a credit report, that doesn't make you what we now call fundable, right? A lender has different guidelines that you need to meet in order to get approved, not a credit score per se. And so that started my journey from credit repair over to what makes someone fundable, what makes someone become eligible to get a loan. And in this case, for your tribe, real estate loans, right? Or business lines of credit, business loans that they can write a check and take down a deal. That's and so the last 30 years of my life, I've spent finessing teaching borrowers how to become fundable and what metrics lenders use, what metrics FICO uses in order to evaluate us so that we can become the perfect borrower, the perfect customer for banks and lenders.
Wow. Okay. So that's an interesting trajectory. So that sounds awesome when the kind of market forces are predictable and you kind of know what you need people to do to kind of, get in through the door to get those loans. What happens in something like 2007 and 8, where in the run up to it, pretty much, I don't know how much business you needed because it seemed like everybody's getting loans.
Anybody
anyway.
could get it, right?
So what were you doing in the run up to that boom? And then what were you doing afterwards when it suddenly became incredibly difficult to get a loan?
Brilliant question. So in the run up, like you said, if you could fog a mirror, everybody says it. If you could fog a mirror, you could get a $500,000 or more loan for a mortgage, right? But what was interesting is that, and this applies also now with COVID, right? With any kind of recessionary collapse, is that the lending target, think of it as a target, and the lending criteria is really broad and wide. I mean, the outer reaches, those outer rings are all fundable. It's 2007, straight up, everything was fundable in those outer rings. After 2008 and during COVID most recently, anytime there's recessionary pressure or if there are financial distress in any regions or in this case, the entire nation, then the scope, the actual funding target shrinks. Right. Interestingly enough, and what I do is I make sure that borrowers are perfect borrowers. They're hitting the funding bullseye. They're hitting the exact underwriting criteria, even in prosperous times. Way out here, we can actually show you how to become fundable in this in a prosperous environment. But what's awesome, and my clients have found both in 2008 and recently, is that when the lenders contract, if you're still a bullseye borrower, to use a phrase, if you're a bullseye borrower, they still will lend to you. We've in COVID alone, my clients have taken down over $35 million in these loans, right? In business lines of credit, business loans, and super jumbos, etc., because they have been able to focus their borrower behaviors, focus their credit profiles on exactly what a lender needs, regardless of how the economy is doing. Does that make sense?
It does. Can you give us some layman's examples of what stuff people would have qualified for pre-COVID? You know, they're in those outside rings that suddenly changed and then they couldn't do now.
Absolutely. So credit cards or Fannie Freddie loans, right? Fannie Freddie loans would, if you're trying to get a new investment property, or you're trying to get a residential property, the Fannie and Freddie guidelines were a little more lax. You get 580s instead of 620s, right? You could qualify. The numbers move when it comes to your FICO score, and if you have a likely source of income and your job continuation is likely, which is an expanding market, then you don't need as much documentation for a Fannie or Freddie loan. Similarly, like private loans, like blanket loans, pledge loans, commercial loans, all of them, if you're out in the outer barriers, you know, during a prosperous times, then the score is more lax and the underwriting requirements are a little more lax. But if you actually tighten up those borrower behaviors so that you're a bullseye borrower in the generous times, you get better terms. I mean, know, there are AAA mortgages, but brokers don't like to give AAA mortgages because they don't make as much when they sell it onto the secondary markets, right? Sure. And so, but they have to give you that AAA mortgage rate if you are hitting all of those AAA guidelines. That perfect example.
Best commissions were in those subprime loans, right? Back in the day.
No joke. So you actually have to force your mortgage broker to say, I want every one of my underwriting criteria to count because I know this is a spectacular profile.
Yeah. So was it the case then in the last, year and a half or so, we had this enormous intervention by the government and the Fed to keep interest rates really low? But you're saying at the same time, the people that are actually lending the money or insuring the loans, Fannie and Freddie, actually made it harder to qualify for a loan.
Initially in the COVID. So bless their hearts, man. This never happened in 2008. I want to juxtapose COVID versus 2008 for just a second, because notice in 2008, we had never had just this wholesale slaughter where the second you went 90 days, the notice of default came, and then immediately the eviction proceedings began, and they were just after homes, right? You had to go 90 days late on a mortgage to even think of getting a loan modification, which took months or years to even to get taken care of, right? The system was not set up to be able to do any of this stuff. Well, all of the lenders, including Fannie and Freddie, learned from the failure of 2008. Because remember, we had almost 5 years of entire subdivisions and neighborhoods empty of homes that had been foreclosed on. They hadn't even made it to auction yet for real estate investors to go pick up. Of course, there was the few, but there were neighborhoods and neighborhoods of empty. And
Yep.
so they're like, we're not making any money with this. So this time around, Fannie, Freddie, and all of the lenders, and I attended some of these seminars, and it was amazing to watch kind of what's going on in the back room. I represent borrowers' perspective, but watching lenders kind of to figure out how to do it this time was fascinating. And Fannie and Freddie basically, they came up with an automatic, you barely even had to ask, hey, what do you guys happen to have a moratorium on payments, and yes, we do. Here's how you qualify. I mean, it was literally leaning in. You didn't have to do much to get the first 6 months. Then a means test was applied to extend from 6 months to 12 months. The banks and Fannie Freddie did not want to have all of this inventory again. So they began for displacing each monthly payment, and ultimately will end up on the end of the loan, right?
Sure.
And that loan, so they'll get the same amount of interest, they'll make the same amount of money, but in the long-term interest, they decided to not go through the foreclosure route, which tore them up. Notice how many banks consolidated. We lost the WAMUs of the world, the Countrywides of the world. I mean, so many people got absorbed or displaced as a result of that process. Now they're saying they're even thinking about 18 months worth of moratoriums, just to make sure people, and there's a more severe means test, but they want to be on the right side of history this time than on the wrong side that they were in 2008.
I was amazed because I log into my mortgage portals every now and again to check on different types of rentals, single family, multifamily. And I was just amazed at how prominent these big buttons on the website were. Click here if you want to put a moratorium on your mortgage. And I was like, I'd never missed a payment in years, but it was like almost clickbait. They're like trying to get me to click on this stuff to pause my mortgage. I don't know why they would actually want to encourage me to pause my mortgage unless I really needed to, but they were big buttons all over the place. Click here, click here, click here if you want to pause.
Clickbait is the perfect word, Colin, because they knew they had the backing. They're Fannie Freddie, so they knew they had the backing. All these servicers knew that they were sitting in the warm, cuddling arms of Mama Fannie Mae and Freddie, right?
Yeah.
And so but what was interesting when I was in these seminars was the compassion. It was not a financial ploy. It was there was almost like a revisit of those old brutal times. It was fascinating to watch the speakers say, we get to do it differently. We get to step into the shoes of the borrower. We get to make this be a different experience for all of us. I mean, now that could be a ploy, but speaker after speaker after speaker was resonating with this. We got to do this differently because it did not work last time. And so now we see in the policy decisions, we totally see 6 months given. 12 months, probably. 18 months, well, let's ask you a couple of questions, but maybe.
Wow. And what do you see after? Because we're getting close to the 12 and the 18 months now. What do you see happening? Are we going to see a big glut of defaults? Are we going to see a big glut of people listing their homes for sale because they're not able to catch up on mortgage payments anymore, or they can't start making monthly payments?
Well, simultaneous to this, the weirdness of the COVID, we have most metropolitan markets are in the it's going through the roof.
Buddy,
we have 10 to 20 offers on little 2,000 square foot starter homes that are going 10 to 15, 20% above the asking price. I mean, it's crazy what's going on out there, right? And so we have all this demand. So those people who are rejected by Fannie and Freddie, which is the majority of our, the loan base, those who may be rejected or don't pass an 18-month means test are have a place where they could sell at a profit because they bought it before this run up, right?
So they'll eventually get to that place where they'll say, look, after the 30th of June, you're going to have to start paying your mortgage again, or we're going to come after you and foreclose on you.
And they know, or especially those who've been around, especially people who listen to my podcast, your podcast, and are trying to tap into the people who are in the know. They realize that the second it goes into default, it's very difficult to sell the property, right? Because it's already snowballing towards foreclosure.
Yeah,
So
those fees add up.
so those people who can't pass the means test and are facing foreclosure in the face or inability to repay, there is a market out there to let go of their property at a profit. So I see
Yeah.
that there's going to be a significant number of people who do that. The other one, the other scenario is those who pass the means test just bought another 6 months. Those who do not have, who are kind of in the middle, right? They're going to go into foreclosure. Then I do not know. Nobody's talking yet about the foreclosure strategies. Are they going to double the period of default? Because all the economic indicators that just came out, I think it was this week, all the economic indicators are saying that the economy is picking up. There's more employment. There's more things happening. So what they may do is actually extend the default period. While it's technically 90 days for most states, they may extend that default period to give people one final chance, but be under the gun, right? I got to do something. I got to do something. So, and if they goes to notice of default, and then once notice of default, once the eviction process hits, then we're going to end up with some significant number of homes that are going on the profit. I do not want to be on the steps of the county courthouse when those things go up for sale in this current market. Can you imagine? They're saying, yeah, I need the amount of the note. Give me the amount of the note as the starting sale point. And all of a sudden people are going to be just ratcheting those things up in the current
I'm
market.
already seeing it because the foreclosure volumes here are about 4% of what they were a few years ago, and demand is about twice what it was. So people are paying huge money. I mean, the mortgage might be 120,
Yeah.
but people are paying 170, and it's worth 180 after a $30,000 renovation. So I don't know where they're getting their numbers from, but they're
Exactly.
doing it. And
It's insane. So those are the three populations that I see. The ones who might be given a little grace in the default period, but ultimately end up in default. Then real estate investors, it's a free for all at the county courthouse, right? And then
yeah,
there's going to be the people who qualify in the means test. If I don't know that it's actually happening, but the word is that they're looking at what percentage of people they can save with 18 months and how many homes they would be able to keep off the market. That's kind of the deciding factor now.
so who's suffering during these 18 months? Because obviously the borrowers aren't suffering because they're getting an 18-month holiday and it's just tacked on to the end. Fannie and Freddie are quasi-governmental entities. They'll just print and borrow money to cover whatever they need to cover. So who's actually going to suffer when it gets extended from 6 to 12 to 18? What's the danger?
There what's it we're in the eye of the hurricane, right? Where it's calm as day, the sun's shining, it's absolutely beautiful. It was a mess getting here into the eye of the storm, and then coming out of it's going to be a mess. But right now everybody's looking around going, home prices are up, foreclosures are down, what the let's get a tan, right? It's just sunny day. Well, the fascinating thing is when we start moving back into that cyclone, that storm mess, I believe that the parties that will be ultimately injured are the future generations who have to pay the bill of printing all the money, because Fannie and Freddie simply have to ask for the loans from the Fed. The Fed now is 0%, 0.1%, something. It's ludicrous. And then so they're going to ask for loans from the Fed, and those loans are going to carry all of everybody who's been part of the moratorium process. And then, but it's not going to harm the lenders. And in fact, because this is going on, because they've been able to sell all their book to the secondary markets, the lenders have more capital to lend now than they ever have. They actually have more money to lend and fewer borrowers because we're now not out on the outer rings. We're on the inner rings, and that smaller target for anybody who's in that bullseye, they got money to burn, and they'll lend that money.
Yeah, I'm with you. It's easy for those big guys to get money. It's easy for experienced flippers to get, private money. Maybe not so much for newbies coming on the market. So what stuff can people do to move from those outer
Sure.
circles into the inner circles? Give us some actionable tips for
Absolutely.
people that want to
So
get those loans.
that's my market. The first thing you can do is right now, hard money lenders, because it's just it's a land grab, right? Um, uh, Hard money lenders are able to charge a little bit more or charge a premium
Hmm.
because of the marketplace, right? So instead of charging whatever it is, 10% and 15% interest, I've seen locally it going to 12 and 15% points and higher than 15% interest.
Hmm.
And so the way to get into that game is to have your own skin in the game, right? They require 20%, 30%, 50% of the deal. So what we help borrowers do is qualify for business lines of credit or commercial versions of credit, real estate credit lines, where they can then have skin in the game, right? We've during COVID, we've had 500,000 and higher real estate lines of credit through certain of our lender base, who are
Hmm.
all looking at this going, all indications so far, there's going to be something. We need to prepare against something in the future, but all indications are that current credit lines are going to get paid back, and we're going to make enough money to handle our risk. And so we help borrowers get these credit lines, real estate dedicated credit lines, even tier 1 and tier 2 bank credit lines. Wells Fargo, Chase, they're giving, for these bullseye borrowers, they're giving away $50,000 and $100,000 credit lines that an investor can write a check and take down a property, and then work on their long-term Fannie Freddie takeout, or use these credit lines for their flip costs, right? Their rehab,
Hmm.
and then be able to get long-term financing, either private or Fannie Freddie. So
Very
that's
cool.
those are the instruments. Now, some of the key things, like you asked, right? Some of the key things we can do to be, instead of being an outer ring borrower down into the
Yeah.
bullseye borrower, there's several. Let's cover a couple of them.
And let's cover a few for people that want to like take out loans for just rental properties, just regular kind of
Absolutely.
conventional loans.
All right. So one of the it's so 30 seconds on underwriting. There are two
Hmm.
types of underwriting. There's manual underwriting, which is what people call full doc, and there's
Yeah.
automatic underwriting. We're seeing more and more, led kind of by Rocket Mortgage, by Intuit, but more and more mortgage lenders are doing automatic underwriting, meaning they examine your borrower behavior over the last 24 months, and then they'll predict how well you're going to be, how little risk you are, and how likely you are to repay your debts, right? It's all automated. There are 40 borrower behaviors that FICO and lending software measure in this automatic underwriting model, right?
Hmm.
Instead of the 7 or 8 metrics for a full doc loan, right? What income and proof, assets and proof, down payment proof, source of funds, all those things, 7 or 8 over on the manual side, but automatic underwriting measures 40. So the more we know what these borrower behaviors are, and then the more we dial those borrower behaviors in to fit the underwriting guidelines, the more fundable we are, the more qualifications we're going to get. And
Hmm.
so some of those are, so automatic underwriting is about data rather than documents. And that's the
Gotcha.
big distinguishment. We want our data to be like tight, bulletproof, whereas documents are, some of us have it, some of us don't, so we qualify or we don't. one of the gatekeeper of approvals, you're going to laugh, but it decides whether your application moves forward or is rejected out of hand. And that is your identity. Many of us, before I knew what I was doing, Colin, I was applying under Merrill Chandler, Merrill Ray Chandler, Merrill R Chandler. That's no big deal in manual underwriting, because you show your driver's license, they look at your face and like, all right, I got the right guy. Not so when it comes to automatic underwriting. They're actually measuring the data points. And real estate investors notoriously have multiple current addresses, because the current addresses are all their current rental properties, right?
Yeah,
and
and
so
that's my case. And I'm Colin Murphy, and I'm Colin G. Murphy, and I'm listed in this one in Florida and this one in Alabama and whatever else.
yes. So now when you go to get credit, like unsecured stated income, these business lines, right? Business loans and lines of credit, you're looking for 100 grand, and you put in your information, they check all the databases, and there's 18 versions of you, each of the versions of your name, and then all the different addresses. Those are 3 to 18 different possible fraud transactions. And so one of the first things we can do is clean up our identity to make sure that when we submit an application and it's going through automatic underwriting, that it says, okay, I know who this borrower is. Next. And then let's look at, income and or the nature of the company, things like that. So a bullseye borrower has a single version of their name, address, phone number, etc. When we have multiple, then that just compounds the number of people we could possibly be for them to have to sort through or send us to manual underwriting, and now we got to prove up, right?
Okay, and is that something that could trip up someone that has a high credit score and thinks they're a shoe in for a loan? That's the kind of stuff that might get them, denied or delayed.
Yeah. In fact, if I may, let me kind of speak to that. We've been led to believe, and it's not our fault, but we've been led to believe that your credit score is more meaningful than it actually is. It is actually the 5th or 6th metric that is used or included in a funding decision. It has never approved you for anything. Your score is in charge of rate and term, and it's in charge of the loan amount or the line of credit amount. It has never approved you for anything. So all of us are walking around going, I got an 820 credit score. And yet so many people come to me going, why won't anybody give me money? Because your score doesn't matter to underwriters until you passed all of these 5 other things first. Does that make sense?
Yeah.
And so yes, your identity can pull you out of the mix. Your credit score, I'll take a 700 fundable score over an 800 fundable score any day, because you can have artificially high scores that don't mean anything to a lender. And so we need to focus on what they're measuring. Now, remember those 40 characteristics I talked about? Those 40 characteristics are measured in increments of 3, 6, 9, and 3, 6, 12, and 24 months. Each one of them predict the same increment in the future. So the last 3 months predict how you're going to show up in the next 3 months. 6 months back is 6 months forward. 24 months back is 24 months forward. And most of us don't know what the borrower behaviors are. So we're just believing all these misconceptions, all of these misunderstandings when it comes to how credit and funding actually works. And then we're surprised when we have an 820 credit score, a 760 credit score, and nobody gives us money.
So if that's like the 5th thing that people look at, and if one of them is making sure your name is kind of consistent, your address is consistent, what are the other 2 or 3 things people look at that are super important to getting approved?
Absolutely. So one of them is, like I said, identity. The other one is the 24-month look back period, just how those 40 borrower behaviors are being measured. Another one is the quality of your credit profile. There is a massive difference between tier 1 and tier 2 banks, like depository financial institutions, the Chases, Wells, BB&T, PNC. They have a quality and grade to those credit instruments. But if you and they're called tier 1, tier 2 regional banks, credit unions are tier 3, and then there's financial institutions. The worst of the worst are retail cards and online or internet cards or internet banking. So what happens is if you have a retail cards, you're actually way out here on these outer rings because you're classified as a consumer. In fact, FICO has a indicator. It's a negative indicator that shows up on your profile saying that you have a consumer finance account. If you have one of these, it downgrades your value to a prospective lender.
Oh, even if you just pay off the full balance every month on your Macy's store
Has
card or whatever it might be.
it has, yeah. I wish it were otherwise, but don't shoot the messenger. But
Okay.
but the bottom line is that the types of credit you have matter to lenders, especially business lenders, especially commercial lenders. Now, remember, it isn't that your loan officer is not going, "Oh, you have a Victoria's Secret card on here. Shame on you." No, it's that the underwriting looks at the who's carrying the paper, and it's all in automatic underwriting, and it's downgraded because it's looking for these various negative indicators that literally like a weight, an anchor that we're carrying around. You may pay your bills all on time, but what bills are you paying on time, and how many of them do you have? That's the quality of profile that I'm referring to.
Wow.
And then another one of the criteria is how you manage money. How many times do you punch through zero in your checking account, for example? Right now, this one's I gotta say it. So most of us, when we go to a bank and we open up a checking account, they give us a free check guarantee card, right? The check, kind of a credit line to protect so we don't get insufficient charges, right? Well, actually, it's used by lenders to, when you punch through zero, you're showing to the lender that you don't know how to manage your own money.
Yeah, that you
and
regularly run out of money.
therefore you're using their money, and so they're not going to give you anything else. That's why you never see $10,000 check guarantee limits. It's always like $500, right? They just give you enough to say, dude, why can't you keep it above zero? If you can't keep it above zero, I'm not going to touch you. So the number of NSF charges that you get is insanely indicative of how you're managing your own money. And they're not going to give you any of theirs if you don't know how to manage yours. So there's multiple variations on these first 5 indicators, right? There's deep dives on all of it, but they don't even look at your score until they see these other priorities are met.
Wow, that's some really good tips. So don't, try and avoid store cards. Don't let your checking account balance get below zero. Any other mistakes that you commonly see people make that derail loan applications? 1 or 2 more?
The big one is make sure you fill out every application, pick a name, version of your name, and use it every single time you apply for credit. The same version of your name. There's ways to clean it up. We haven't got, that's outside the scope of this conversation, but you've got to make sure that you are only known by one version of your name. That it's huge. Other things, we call them landmines, right? Funding landmines that people just step on are, for example, they're huge. This is a great one to end on, Colin, because it's going to blow away a huge percentage of your audience. There's FICO scores, which are used by 90% of lending decisions in America. FICO, and then there are FACO scores. A FACO score is defined that no lender uses it to approve you, because why would you count on a score? That's like playing a basketball game. You don't know where the scorecard is. So you're looking at some random person holding up a placard in the bleachers going 723. It's meaningless.
Are you
It's
talking about these apps that give you your score and they're not
if
related to
it
an
do,
actual
yes,
FICO?
if it doesn't have the FICO registered trademark, it is a fake score. The number one fake score in the country is the score produced by Credit Karma. 80 million Americans base their financial self-image on a fake score. A score, by the way, that when you see it on the front page, but then you go apply for a loan on one of the Credit Karma tabs or a credit card, they pull real FICO scores to evaluate you for credit. They don't pull even the score that's on the front page. It's called Vantage. Vantage is a fake score for all the lenders don't use it. So now that's a huge landmine, because we hear all the time people walking into an auto dealer and go, yeah, I have a 720 credit score. Here's my Vantage score. And then they pull a 680 or a 670 FICO.
Yeah. Mm-hmm.
And there was a study done that I believe it was 1,000 borrowers. A study was done where the average of the average Credit Karma score was 30 plus points higher than their FICO score that
Wow.
lenders actually use. It's
a lot.
BS, and excuse my language, but that's a huge landmine we have to avoid. So a free tip for your audience: if you want to know the truth, go to myfico.com. If you want to do real credit monitoring with real scores that lenders use, go to myfico.com and check out your credit there, because real FICO scores, and it gives you the truth of your situation. And we can't do anything unless we know the truth of our current situation, right? There you go.
Wow, that's some great tips. I love it, Merrill. I love it. And before we finish up, I'd love to I always love the kind of gossip and the scandal stories. Do you have any anecdotes you can share from people that thought they were smarter than they were and took things way too far?
Yeah, absolutely. Okay, so this one, this one again will probably pull the rug out from some of your listeners. People think that it's good to be an authorized user. It's a great way to raise your score. Well, since lenders don't care about your score until you pass muster. Well, one of the things that lenders look at is if you are an authorized user. Remember how we said the quality of accounts? Well, guess what is even worse than retail cards? Being an authorized user, because you're not in charge of the payment. You're just piggybacking on somebody else's reputation. It's a free ride. Well, the reverse is also true. And here's the story. We had a gentleman come to us, and he was panicked because he had spent 6 months developing a relationship with Chase Bank. And he got approved for a $10,000 credit limit. And he was like, I am so excited. So there is a market out there for people to buy trade lines. Okay. That means you put them as an authorized user on your account, and people will pay money for it. Right. Problem is that lenders are watching for this. This gentleman who worked all this time to establish this relation with Chase put some rando on his as an authorized user, and within a week the entire account was shut down.
Wow.
First of all, the individual who was put on had horrible credit, so it was easy to do a soft pull on them and say, you know what, if this person has access to our money, no way. And so not only is it bad to be an authorized user, there are many circumstances where it is horrible for your profile for you to give access to an authorized user. Now, the exception to that are children of the same household, going to college or otherwise. But anything beyond that, the credit bureaus are watching. I mean, FICO's watching, the credit bureaus, the lenders, everybody. That's gaming the system, and they're just shutting it down.
Yeah, I can imagine people thought nobody was going to notice if you can piggyback on your uncles or your wealthy buddies. Yeah,
Yep.
but you could be ruining your wealthy buddies' FICO scores. and hunting your own while you're at it.
Shutting down the account. Exactly.
Wow, that's crazy. All right, well, I really appreciate all these insights, Merrill. There's a lot of them in there. There's a bunch of little segments that people could rewind back and listen to again. I love that stuff. So before we wrap, I want to tell us a little bit about your business and how it helps people.
Well, we're called Get Fundable, and Get Fundable is all about educating people to do this. So I have a book, I have a boot camp. Go to getfundablebook.com. It's free. I'll give it to your listeners, Colin, for free. If they'll just cover the shipping, I'll get it out to you. So it's a national bestseller. It's called The New F Word, and that stands for fundable. Anyway, and then so getfundablebook.com, and then there's, if you want to spend 2 days with me live, just going through the stuff and looking at your own situation, we have a boot camp called, and you can find that at getfundablebootcamp.com, and just read the reviews. I don't have to speak for it. Just read the reviews. It's life-changing reviews because of this. Imagine 16 hours, Colin, of this level of information. It's
a lot of insider stuff in there. Yeah, I can only imagine what 16 hours could do to change someone's trajectory that have just been kind of coasting along without paying attention over the years.
Yeah, if somebody wants something for free, then you can also go to getfundablechecklist.com, and I have a complete, the ultimate fundability checklist that's free of charge. Just tell us where to send it. Happy to.
Awesome. I'll get all those links up in the show notes, Merrill, and thanks again for your time. Really enjoyed the conversation.
Glad to have you. Glad to be here.
There you go, folks. That was show 52 of Colin podcasting about real estate with Mr. Merrill Chandler. I hope you enjoyed that. I hope you appreciated Merrill's insights into the lending market. I certainly did. I learned a lot of stuff in there I didn't know, quite frankly. I mean, I've applied and received a lot of different loans, conventional loans, private loans. I mean, millions and millions of dollars of loans, but there's a lot of stuff in there I didn't know. And maybe I would have gotten some better deals if I did know them, or slightly better rates. But I will. And one thing I was, very surprised by that whole thing. Keep your name the same on every single document, and it makes complete sense, of course. But I've got Colin Murphy and Colin G Murphy all over the place. You probably noticed me using both interchangeably in this podcast as well. So I better sort that stuff out too, and probably different addresses for the different rental properties too. I know that when I'm searched for my name and on some kind of lookup service, I came up at some random address in Alabama where I own a house. So yeah, who knows, a lot of stuff that you can fix in there. I did appreciate his insights in the mortgage moratorium side of things as well. That is interesting how that's going to pan out. I mean, things have to change in the market pretty dramatically when you have, potentially millions of households who haven't been paying their mortgage suddenly being told that they have to start again. I mean, I don't know what percentage of them are going to be able to start again and what percentage are going to have to just sell the house or let it go into foreclosure. Either way, you have to figure inventory is going to increase quite a lot when that point is reached. It might be managed a lot smoother than what we saw 10 years ago, but who knows? We'll wait and see. I suspect it will be managed a lot better, and that the pent-up demand will be able to absorb a lot of that supply increase. But nonetheless, it will change the market. It will change the economy. It will change the real estate market when that massive government intervention is lifted, because it's artificially keeping foreclosures down. It's artificially keeping real estate transactions down, and that's not. You're most likely going to have, it's a pendulum. I mean, and if you're forcing it up one side, it's going to swing much further down the other side more often than not. We'll see. But make sure you're liquid when that happens. Make sure your credit score and those other factors are in crispy clean condition. Make sure you're positioned to borrow money when you need it, or lend money when you need it, or spend money and invest money for opportunities that are out there, because the people that aren't prepared are going to be on the other side of those transactions of the people that are prepared. And I know which side I'm going to be on, and I hope you do too. And this was a timely reminder of the importance of that. And so thank you to Merrill. Check out that website, getfundable.com or getfundablebook.com for his book. And thanks again for for tuning in to a year of Colin podcasting about real estate, especially those of you out there who have been with me from the start. A special thanks to you, and obviously a special welcome to people that have been joining the club more recently. And by all means, go and check out some of the older episodes. There's a lot of good stuff in there that hasn't dated at all, so check those old shows out. Do give me a rating or a review if you have time. I really appreciate those. And like I said at the beginning of the show, I would love it if you could send a quick email to info@colininvestments.com and let me know which was your favorite show this year, which guest made the biggest impression on you. I'd love to know that. And if you have any suggestions for future guests or future topics or themes, love to read that stuff as well. I want to hear from you, and I want to produce content that is of interest to you as well as of interest to me. So yeah, go and do that if you have 5 minutes. Thanks again. But for now, this is the end of show 52. I'm signing out, guys, and I'll be back soon with show 53, which will be the first of year 2 of Colin podcasting about real estate. All right, until then, take care. Bye-bye.